high net worth individual who typically owns a majority share and controls it as a partnership, usually, and we'll be deep diving into what an S corp is, but a lot of times it's a one of the two. It's a 1065 or an S corp. An S corp is a tax election. It is not a legal election. Usually you'll start off either at the bottom of an LLC or a corporation. So a lot of people in this Zoom will be either Schedule C or 1120S. If you're not an 1120S, the question should be asked why, and you should understand the reasons of why or why not. And we'll get into this idea. Many people shouldn't be. It's really person by person specific to understand what your tax situation would look like. Then you have corporations. Those are the large, typically large businesses. Not a ton of corporations. We'll go into that later, but the word corporation is thrown around a lot. You could see it's very confusing, the difference between just one letter, S corp, common, corp, not so common, but very common in the big, large business world, not the, I wouldn't call it smaller, but let's call it family, high net worth, not the Googles of the world. And then there's an LLC, which literally you could open one up. I'm sure most of your clients, especially if you're in the business world, have LLCs. You could open them up easily. You could form them. You could have them. A lot of people have LLCs just waiting. You know, they might not do the LLC as the property name. They have it waiting on demand. An LLC is beyond flexible. It can literally be most of the items above of a Schedule C, a 1065, even an 1120S. It cannot be a corp, but that's a different story. But an LLC is typically where most people start off as. Whether it's a PLLC for New York, a lot of times they need professional LLCs. It's the same idea. An LLC is the most flexible. If you want different partners and partnerships, usually you'll start off as an LLC. After an LLC, you might elect S corporation status, as in legally, a lot of S corps start off as an LLC and then they elect to be a S corp. And that election you should run by a CPA. I have so many clients who they read a bunch of information online saying S corp's the way to go, which maybe is not, but they just start making elections. Of course, they don't do it right. They don't do the state right. They don't do the federal election right. And then it just causes a lot of issues. There are a lot of hoops to jump through for the S corp, but it is worth it if it's the right entity structure for you. I love how my intern put all these little transition things in. So most real estate professionals, brokers, you are doing your own taxes. It's not like you're W-2. I usually tell clients who are W-2, like one or two W-2, if it's small, you don't need me.
The window bigger?
What window? This one?
That one.
Not my windows. Okay, perfect. Your windows.
This is click on him.
Perfect. So most realtors, they're doing professionals, you're doing your own taxes. You're not a W-2. You're not going to be doing it yourself typically in a TurboTax. I don't even work with TurboTax. There are clients I tell, you're one W-2 of 100K or less. I mean, I can't really add value to you. Typically, when it's a seven-figure W-2 and there's a lot more transactions and complexity, of course you need a CPA, but especially for business owners. And pretty much everyone in real estate industry are business owners. They're doing their own taxes. It shouldn't be a once a year item. It should be a planning. It should be a multi-conversation throughout the year. While a lot of the work for a tax return is typically done throughout January through April, most people, and if you're not, you should ask the question, why go on extension? And I have many clients, they ask, oh, I don't do extensions. I've never been on extension. And before I even take them on, I ask them why. And it's usually just this unknown fear of what April 15th typically means, or March 15th for the business entity. So if you are a business entity, the deadline is March 15th. And I inform the client of why we think an extension is a great idea. I use this line, all high net worth individuals go on extension. Do you want to be a high net worth individual? And then they think oh, I guess why is that? You and your accountant or future accountant will be a lot more creative during the months of May, June, July. than a fake gun to your head to file by March 15th and rush it. Even though we don't rush returns, your account's not going to be calling you up the day before the deadline and ask you, I noticed you're missing XYZ expense. This is what we typically see on a business owner. Back to the taxes on the last line here, self-employment tax and income tax. Those are the key items, and the self-employment tax being one of the main items. I use a different word for sometimes the self-employment tax to put it in perspective. It's like a payroll tax. If you don't know what that line is, self-employment, you should. That is one of the largest tax saving strategies what we're going to discuss moving forward. You are paying it. It is currently buried in your returns. Returns, I mean, if your return's a couple hundred or even sometimes 1,000 pages, who knows? It's more and more complex. I usually tell clients to look at the summary page of page 1 of the returns we send. But the 1040, the 1120S, all these returns are getting larger, more complicated, with more lines. I mean, if you're deep diving into your return and looking at page 88, that's great. But most people, I mean, you have things to do during your day. You're not going to become tax experts to review every line. You should at least review the first couple of pages and the summary page of your tax return, because buried in it is, no matter what, your self-employment tax, of course, your income tax. But within your income tax, you see, oh, I owe 100K this year. Within that 100K is buried in there a huge component, which is your self-employment tax, which a lot of times typically funds your retirement. Should retirement income, Social Security be available when, I don't know what the age group of this Zoom is, but when Social Security happens and you get your check, it's because you paid in every single time on your tax return in your self-employment item.
Jay, can I interrupt with a quick comment?
Yes.
From the questions? Carla was just asking to clarify. So any realtor working for a brokerage getting a 1099 has a March 15th deadline, not April 15th?
Incorrect. Typically, if you're 1099 as a real estate salesperson, correct?
Yes. Yes, any realtor working for a brokerage.
For a brokerage. It depends on what the name/social/EIN number is on that 1099. If you are strictly a salesperson, 1099 came to your Social Security number and your name, that is an April 15th personal return. The Schedule C is a personal return schedule. So it's buried in your 1040 personal return. The way you've always done taxes, you report all your business income and losses on a Schedule C within your personal return. Personal return deadline, April 15th. If that 1099, let's say, goes to a brokerage, an independent business, or an S Corp, or a 1065, as noted on this screen, where it's a pass-through entity, those returns are a March 15th deadline. And I have so many clients, they either start an S Corp or a partnership, and they don't realize that a March 15th deadline even exists. And if you miss the March 15th deadline, besides the possible taxes that could be due, the government is not easy on the interest and penalties for non-filing for business entities. Certain states have a monthly penalty for not filing by March 15th, your extension or return. And those are these pass-through entities, 1120S and 1065. These are entities where the income stops off. So let's say the 1099 went to a S Corp or a 1065, not your Social Security number, but an EIN number, which is a different number for your business. The money and the income and loss stops off on a separate business return due March 15th, and then flows into your personal return after all your deductions, giving your personal return a different net number. As in, if you have $1 million flowing into your 1120S or 1065 business entity, then you take your expenses. Let's say you have expenses of $250K. Your K1, which is kind of like your W-2, it's the information that flows from a business to your personal, net 750 will flow into your personal return. So all the information of your business will be paused in a business return, and then the net number flows into your personal return. That's what a pass-through entity is. Most wholly owned small, medium, and large businesses are this type of entity, 1120S or 1065. Real estate ownership, I've seen a few real estate and properties held in an 1120S, which is an S Corp. That's old school. Usually that was set up in the 80s. Typically, I have not seen a real estate property outside of a 1065 in years, just because it's not done for a multitude of reasons. We could get into it. It's a lot of times tax savings as well as legal structure. I use this line with clients or prospects. I can't talk law, even though I'm on calls with lawyers charging $2,000 an hour and they bring 10 of them onto calls. I'm always on the call because your CPA should be on that call. And I could give advice, but it's not legal advice. It's CPA, tax strategy, more advice on the legal end, which would be, I'm not a lawyer, but this is how every other person in your industry does it. You could decide to go hire a lawyer to confirm it, but that's not on us. And that's on the 1120S verse 1065. Those are in the same bucket, I would say, of pass-through entities. And then there's the 1120, the corporation. And it's very confusing because S corporation and then there's corporation. A corporation is a non-pass-through. A corporation is your Google, your Amazon. These are the large, big companies that if you own Google, Amazon, any of these big Fortune 500 type of companies, you're not going to see a K1. If Google makes $1 million in your name, you're not going to see a K1. It's not going to flow through to you unless they issue a dividend, which is a separate type of, let's call it type of income. But you will not see a K1 from these type of entities. You'll see other types of forms. But that's why we typically do not see many 1120s, which are the corporations for small to wholly owned, or even in the real estate brokerage commission income lane. I think I've seen one, and we converted it from a corporation to an S corp for many, many reasons. It is rare. I mean, we do a bunch. Thank God we do a lot of returns in here in our firm. There's not that many 1120s. If you are an 1120 as a, let's call it small to medium to business, typically you'll see this when a company is trying to do a small business exit tax-free. So it's in the startup lane. So it's either you're a Google or Amazon, or you're a startup that expects to have an exit in year 5 or year 10 for multi-millions of dollars, which could possibly be tax-free. It's another lane where the IRS and the government decided that there's amazing tax benefits and impact to being a C Corp. It's kind of like the laws for real estate, amazing tax benefits and impact. There's a few avenues in the tax arena which have significant things that you might be able to do to save on taxes. And as I said, taxes are the largest part of anybody's portfolio or expense. We're going to jump into Schedule C. A lot of you here are Schedule C. There's nothing wrong with it. Some people are Schedule C for actual legal and tax reasons. Some are just based on income. I have a type of Schedule C. Schedule C just means a profit and loss of any small business. Whether you have your first deal tomorrow, let's say you started and you have a deal and you made a $250K commission, you would typically put it on the Schedule C if you didn't do any other planning. Where it really comes into play is when your income starts to grow, you go out of the Schedule C. Most people, the first question I ask as a CPA is, where is your profit and loss so that you could send to your accountant? I have an Excel, should anyone want to reach out and ask me for it. Bookkeeping is very important. We're going to it. But if you want a basic Excel model to keep track of your books, it works for typically small businesses. Once you're a larger business, especially one with employees, you will have to use an accounting program like QuickBooks or whatever you're currently using. But a lot of, let's say, if you have a couple of deals a year, you're a salesperson, not a broker, no employees, you can use a very basic Excel model, because I just need a few numbers from each client detailing what their income was, which your 1099 will already have, and then expenses by category. The key for this Schedule C tracker is a lot of times people are guessing their numbers. And I know when they're guessing, they're using conservative estimates, mileage, home office. These are things that if you actually calculated it, you'll probably get a larger expense. And every dollar you give to the that you don't deduct. So it's $1,000 computer that you forgot to add to your books. The IRS, you could be in close to a 50% tax bracket with state. You don't deduct $1,000 because you forgot it. That's huge. I use this line with clients. It's like, I can't remember what I ate for lunch yesterday, let alone what I need to expense on my business from last January. So if you're not keeping track of your books on a consistent basis, you won't remember. It will not be added onto your, let's call it books or Excel, and then it will not get onto your return. We're going to move into what the expense section of the Schedule C is. This is it. This is a very high level. I don't even know where this came from, but this is the expense section. It's, everyone has seen an income statement before. What I don't like about this one is you could tell every number was estimated. I don't know how many of you here have exact even numbers on your return. I see it all the time. And typically it's a client coming to me being like, I'm being audited. I don't know why. And I'm like, have you looked at your return? Who has exactly round even numbers on every single expense? And some of them don't even make sense for that individual. I don't know what type of businesses I'm just making up, like car and truck expense. You might have that, you might not. We'll talk about that later. Excessive business. I mean, everyone should have vehicle purchases or type of travel expense in your industry. You're traveling a lot. Contractor payments, we'll discuss. You need a 1099. Are they a contractor? Are they a W-2? Whole nother issue and conversation. Home office expense. I mean, it's 2026. The home office rules were written before I was even born, back, and I don't even know. The internet, way before. A lot of the rule of home office expense is what I typically see with a lot of clients is like, my accountant 50 years ago told me it was a high risk. It's 2026. Back when the internet didn't exist and telephones, yeah, home office, what were you doing at home? All your equipment and information was at the office. Nowadays, everyone has multiple offices, works from home. It is not a high risk area. We're not taking 100K. I just took on a new client, their prior CPA or with themselves, took a home office of 90% of their multi-million-dollar house. That's aggressive. That's a red flag. They will audit you. But the answer to typically a lot of these things is never zero. I use the story. I have two types of clients. One client makes 250K and gives me zero expenses. The first thing my team does when they see 250K is ask for expenses. This client says, no, I don't have any. And I think that's crazy. Why? I know they have telephone. I mean, they're in the real estate world, they have maybe even 1 mile of travel. This client I call crazy every single year, and we file with gross net income 250K, no expenses. That's that client's risk. They feel comfortable with that. I think it's crazy. That person pays extra to the IRS. And then I have another client. They make $10,000 and they want to write off their Ferrari. I go to that client. I'm not signing your return. I have better things to do with my time than represent you in front of an audit where I can't even present it. I use this line. If you can't present it in front of an IRS auditor and they're going to laugh at you, what are you doing? It needs to be necessary and ordinary for your business. S Corp strategies. So this is the main bread and butter of if you are making money, what that means, net commission income after expenses. Sometimes it's 250K net and growing. My partner uses 500K net and growing. You'll see over the internet, there's so much information. The idea being is if you're under 250K-ish, you got to jump through a lot of hoops. You got to pay a lot of fees. You're not going to save money, or maybe you'll break even. If you're growing every year or are way above that, and we typically have clients who are 7-figure net earners, they're saving because in taxes, we're paying the percentage game. If I can save you 3.8% on 100K, I don't know if I'm going to jump through a lot of hoops for that. It's not enough money. Your fees will be more than that. But let's say you make 500K and it's growing to $1 million. 3.8% of 500, 3.8% of $1 million. That's just the start of tax strategy of what an S Corp can do. What hoops you have to jump through? You have to differentiate your income between salary, which is a W-2, as in you are paying yourself a W-2. You're both sides of the coin, employee and employer. Then you'll have distributions. I've seen clients do an S Corp, but they didn't take it to the finish line. They didn't do their distribution salary right. They saved nothing. And I'm like, you got so close. You did all this work, but no one coached you to get to the finish line. Done wrong, no savings. And then you have to pay yourself salary. I see a lot of S Corps. They start it. They think they're going to save. They don't have a W-2. Red flag in the return. It's exactly what the IRS is starting to do in audit. If you don't have a W-2 on your tax return, the question for an S Corp, 1120S, it is a red flag. They'll ask you why. At the end of the day, you're screwing the IRS. They don't like that. You have to pay your fair share. but they allow you to call this S Corp loophole. It's not really a loophole. It's S Corps are the #1 fastest growing entity in the US. I practice what I preach. I am an S Corp. If you're not an S Corp, there are rules and regulations for whether you can be an S Corp or not. There's tax laws, tax rules, there's legal laws, legal rules, and then there's the real estate commission, and they have their own rules. I know for New Jersey, it has not been allowed for certain salespeople to be S Corps for many years. People have still done that because it wasn't a tax issue. It was a legality issue. That has been updated and changed. New York, they have their rules of whether the license has to be within which entity. For brokers, and a lot of you, from my understanding, are brokers, business owners, where the license is held within the brokerage. S Corp is the way to go. If you're not and you're making money, you want to understand why. It could be multiple of reasons, which we'll get into. This is what
Jay,
the
real
left-hand
quick.
side. Yes.
Sorry, sorry to interrupt you. We just have another question, if it's okay,
Perfect.
before you move on. Lizbeth asked, how should we be calculating our home office expenses for our taxes?
Perfect. Very good question. And on our Excel tracker, I kind of give the information because clients don't know. It's typically percentage. It's never 100%. What we typically do and the IRS wants is square footage. So everyone knows what their square footage of their house is. Go on Zillow, get it. Whether you include your basement, that's a different story. That's on you. The IRS is typically not auditing certain home offices, which are taking reasonable home office. So square footage. And then it goes by what the square footage of your home office space is. It's not 1,000 square feet. It's not your whole basement. I don't care that you have your desk in the basement and you want the whole basement to be your home office. It's a couple of 100 square feet divided by your house. Come up with the percentage, then apply the percentage to the rest of your expenses for the house, which can include a multitude of house expenses, which your mortgage interest, not your principal payments, but your mortgage interest, your real estate tax, your utilities. And then you apply that percentage to all that. Let's say you do a renovation. I've had this before where a client specifically did their home office. They put 10K in or their furniture and fixtures for that office. That could be 100%. But for the rest of the expenses that are jointly shared, it is a percentage. It is typically between 5 and 15%. I have a few clients that are higher than 15% on the home office. They are more aggressive. I'm not saying it's wrong, but when I saw 90% on this 10,000 square foot house, and it was 100K in home office for someone who wasn't even making that type of money, I was like, you haven't gotten your audit letter yet, but it's in the mail. Like it's just a red flag. Just like, I don't know if the IRS is starting to use AI. I think they are. And even if not, it's the computer system, not before AI, would flag your return. It just doesn't make sense. So you don't want to be stupid on your tax return. And that's where that comes in. Home office, I feel comfortable taking it on but typically most clients, if the rules allow it, and most of the time they do allow it. So that is on the home office. And same with mileage. Technically, you should be tracking your mileage. And if you were audited, they'll ask for your mileage log. How many of my clients keep a mileage log? That's to be determined. I don't need to see it. I ask for the mileage. But the answer is not 100% deduction on a car that has personal use. A lot of times we'll take a less deduction. Like they're 80. We'll ask the client, do you use it? Do you have another car available? There's a question on the return. Do you have another car available, or how is that car 100% business use? So they are asking about that. You don't want to be aggressive and stupid. You want to be smart about it and understand the risks that can happen in a return. These are just the pictures of what your return could look like if you're in the business lane of an S Corp on the right-hand side and a 1065. As you can see, this is a 2023. It's mostly the same, but they keep adding lines. And it's going to only get more and more complicated. If you are filing one of these returns, the 1099 that you get from either someone else, if you're a brokerage, you're not, but if you're a salesperson, you're getting a 1099, that 1099 cannot have your social on it, and then you put the income on a business return. It's got to match. It's got to flow. So I see that a lot where it's like, where are your risks? This could be one where the IRS says, you didn't even cross the T, dot your I. It's just, you lost your audit before you even started. And then the K1, these are the type of entities: partnerships, S Corps, and trust estates. Usually the term K1, if you haven't heard about it, high net worth individuals, investments, or if you're a sole business owner, you will get a K1. These are the entities that put out a K1. It's issued to business owner. It flows through. It's not a W-2, and it's confusing to say a K1 is a W-2, but I use it as a model to explain to a new business owner. You used to get a W-2 that reported your income. Now you're self-creating a K1 that is giving you your business income. And the key to all of this is anyone could do your tax return. They could be sitting in Wyoming. You could use a Wyoming CPA. Federally, they should be spot on. Half the tax strategy comes down to state level. I wouldn't feel comfortable just because they don't know New York and New York City and New Jersey and California, like state specific rules. And when you're dealing with a state trying to claw 10% of your income, you better make sure you're doing it right. New York, New Jersey, California are the worst. I always say that. Typically taxes, you're paying it to one state, but it's chopped up between all the states. So if you're making income in Florida, Florida's not taxing you. New York will take it all. They'll take the full 10 and 11%. Add New York City, another 4. You could be in 14, 15% New York City. You paid 0 to Florida, even though let's say your income was made in Florida, you pay it all in New York. Let's say you're a hybrid between income between New Jersey and New York. If it's made in New Jersey will take their first share. Then New York will take the difference. Like if you paid New Jersey 8, New York will take their 10 to 14 on top of that. You won't pay 8 to New York, but they'll take the spread. So you're going to pay taxes somewhere. And that's why New York City taxes are a key player to this. PTET. So if you are an S Corp, and a lot of you are brokers, I'm assuming you're already S Corps. This is a secondary tax savings, which was implemented a few years ago. I still see many clients not doing it. It's a SALT workaround. I don't know how many know SALT, but the idea was that if you had business income and you paid New York $100K, they only allowed you to deduct now $10K of your $100K New York taxes, which New York's like, whoa, like everyone in New York's like, I used to get this federal deduction and now I don't, and I'm paying so much more. So they came out with a workaround where you could elect on an entity, so that's an S Corp and a partnership, to pay your New York taxes on the business and then deduct it federally. So high level, you make $1 million federally, you owe what? $100K to New York. Usually you paid that $100K on your personal return because you're filing 2 separate returns. All your taxes were typically on a personal return. Here you elect to pay the $100K on the business. Then the business deducts the $100K against your federal income. So instead of making $1 million, you're now at $900,000 federally. That is huge when you are already in a 37% tax bracket. So this is what every single one of our business clients who make money does. If it's small amount of money, we don't do it anymore just because, first off, the election needs to be made by March 15th. So if you wanted to do this for 2026, tough luck. You had to do it last March. New York is absolutely crazy with this. In addition, this is a manually filed return, this PTET. It has to be done online on the New York website, which is the only return I file manually online. Every other state, every other jurisdiction, you could file within our tax program. Once we're done, we click it, we get it done, which is why either you are currently filing this yourself or your CPA is charging extra because it has significant tax savings, but it also has work. Then New York City. New York City does not recognize S Corp, which is the rules for New York and New York City are completely different, which is why most New York City businesses are not an S Corp, because what you end up doing is saving and then paying it all to New York City. So why jump through all these hoops to save nothing? It does work for anyone outside of New York City who does not have New York City business taxes. Allocations are a whole nother thing. If you are working in Manhattan or the boroughs and you need to allocate income to every single jurisdiction, the S Corp rules and the personal rules are different. The S Corp for New York uses market-based sourcing, which is where your client is. New York City uses place of performance. So if you're doing your deals in New York City, that's place of performance. I have a bunch of New York City salespeople who are not S Corps because all their income is made in New York City. They make a few $1 million, but at the end of the day, it's not worth doing the S Corp because what ends up happening is you just do all this extra work to save nothing. You're just not set up for success. And most people would elect to be like, I don't want to pay New York City what I'm saving. Let's just keep it simple. With taxes, keep it simple is always the best rule. That's why a lot of people are Schedule C, if that's the right reason for them. In addition to the New York City tax, there's a UBT tax. For all businesses in New York City, they pay an extra 4% on top of your personal taxes. This is a business tax. It only kicks in about a 95K and above. There is an exemption for certain real estate salespeople. So I've had clients come to me and we've amended the last 3 years of returns to get this tax back. And it's a couple hundred K because they're high earners. They're paying this 4%. There is an exemption. I didn't know about it many years ago until I learned about it. If they qualify, I can't tell you how many people are paying this New York City UBT tax as a New York City salesperson, and that could be exempt. And typically people in this profession are high income earners. 4% is a lot of money. So this is a type of thing that where you should be on top of it. Understand that if you're paying it, why are you paying it? However, it is buried on page 98 of everyone's return. You're not looking at that. On top of that, on page 98, it's beyond confusing. It's buried under another schedule that says see schedule. So most people don't even know they're paying it. Typically, when you see your tax bill from your either do it yourself, hopefully not, or a CPA, it's like, oh, it's the same as last year. It's a little bit more. Ask why. They'll never catch this because every year you've been paying UBT. It's a question to should you be? Next tax strategy is the simplest one, bookkeeping. As I said before, if you don't tell me the numbers, I'm not taking them. I will ask questions like on a typical broker or a real estate professional, I see this expense, telephone, why don't you have it? Some of the young ones are like, oh, my parents are still paying it. I see that a lot. But on the older seasoned professionals where their parents are not paying their telephone, it's kind of like, why aren't you doing, the answer is never 100%. But why isn't it 40, 50, 60%? The days of people having a designated business belt clip of 2 separate cell phones, way behind us. But that doesn't mean you shouldn't be taking something. If you don't have a bookkeeper or doing it yourself properly with the C tracker that I send to the first thing I do on a sales call is I send them the C tracker, whether they use it or not, I've already added value. Because typically what they're using is like at tax season, I go through my books and I give it and I go through the year's worth. And I'm like, you're going to forget that credit card. You're going to forget that time you went to Staples and bought a new computer because it was a year ago. If you keep track, activate on a monthly basis, typical business owners should be monthly. Smaller business owners, you can do your books quarterly. I don't recommend it, but it's possible. But no one should be doing it all at once at year end. I'm going to talk about a client soon. He used to do it all at once at year end. You know, we're talking about a $5 million commission owner who pays 0 in taxes, but I can't file his tax return because he doesn't give me the books. IRS Section 179, this is all the rage on Instagram and Facebook. If you see the tax strategists trying to pull you in, they're like right off your car. And it's tax 101 to a CPA. If you hear the word Augusta rule, I typically say run away. If you don't know what that is, it's not a problem, but like it's a way to rent your house tax-free. But if a tax strategist or a CPA is leading with that, typically not a CPA, but a tax strategist, run away. You're gonna get an orange jumpsuit. But Section 179, what is it? Why do so many brokers or salespeople drive a fancy Range Rover or a heavy car? You know, wouldn't it be a lot easier to drive a sedan or a low-end convertible or a hybrid? What Range Rover qualifies is the IRS rules are written, as I said, many, many years ago. If the car is over 6,000 pounds and it's used fully for business or more than 50%, you could write off that Range Rover in year 1. So let's say you get a great year, you make $2 million, you want to tax plan, you don't have a car, you could go buy the Range Rover for 100K and write it off your business if it's fully for business. And now you, instead of 2 million, you're at 1.9. It's time value of money. Are you saving? Yes, I would do it. However, you're losing the 20K deduction over the next 5 years. So it's not like you're saving time value of money, but it's not like you all of a sudden got a 100K deduction that you never would have gotten. It's timing. And that's why you'll typically see a lot of people, certain business owners driving this huge heavy car, cyber truck, certain trucks that qualify it. It's called Section 179, and it allows them to write off their car all in year 1. But typically, most people are not buying a Range Rover each year. There's a line, you make the business decision first before the tax. I've seen so many times people, they want to screw the IRS. They're trying to write stuff off and make a decision based on taxes. And I'm like, have you thought about it as the right business decision? Like, I had a client, they tried to do a 1031 real estate transaction for another time. They lost the building after 2 years because they were trying to save on taxes. What they didn't realize, the deal didn't make sense. That's a high level 179. Retirement. So I'm going to retirement. You should be having retirement. As a business owner, you need to take care of it yourself. No one's saving for you. As a W-2, you elect into a 401k. Retirement is one of the largest tax saving strategies. A solo 401k, a lot of money put away, you get it as a deduction. So instead of making $1 million, you put a 70K away right off the top, saves on taxes, SEP IRA. There are plans that are even larger. Most of my clients are doing a full SEP, $70,000 put away. If you're not and they want to go larger, they do a defined benefit plan. There are ways where we refer you to a tax specialist. I've had clients put away hundreds of thousands of dollars, taken off the top of their taxes. They don't pay the tax bill, but of course that money is frozen up in a retirement account. It's something that my team and I won't file a return without asking the question. Do you have a retirement? Why not? We see it on the return. So before a business owner sends us $1 million and I'm like, I don't see any retirement. I'm like, why, what, when, where, what's your strategy? Get it in. And then real estate tax professional. I don't know if anyone's aware of this, but real estate, as I said, tax strategy, tax rules are written in their favor. You are already typically real estate tax professionals. But in addition to that, if you are material participation where you run your own deals, you could pay zero taxes. And I have clients like that. So the idea is if you have rental losses, if you invest in a syndication, you put 100K in, you don't run it, they give you a $50,000 loss on the K1 year one. You don't get that loss. It's buried on page 90 of your return. It's there. You get to use it in the future, but you don't get to use it today. If you do your own deals and you're managing partner and you're 100% owner of a real estate, there are ways where you could take that loss against your commission income. I have a client, makes a couple $1 million easily in commission income, cherry picks their own last business warehouses. He pays certain years zero in taxes on multiple millions of dollars of commission income because he takes advantage of accelerated depreciation, cost segregation. It's a whole nother term, but he blends these tax rules to his favor. So it's a possibility, something that you can look at if you have, I call it the real estate bug, where you want to take care of the real estate planning. Financial year end, high level, make sure your taxes are not done throughout through once a year. I'm never going to reach out to a client and say, let's talk tax strategy, but I'll have links and I'll tell clients, call me before you do anything, but also have a conversation a few times a year. We don't charge by the hour. Of course, I track my team's time, but I like talking to the clients in the summer. During tax season, I'm a little bit more fast. I talk fast, a lot of information to go through. 1099s, you should be aware of them. If you are a brokerage, you need to issue 1099s. They're due by January 30th. Every year they change. There are penalties. I've never seen them implemented to not filing 1099s, but it's typically not part of a tax return or tax process. We do it as a convenience if our clients need it. You should be doing it yourself, 1099s. High level, call your CPA before year end. Make sure your books are up to date. Another tax strategy, review income, accelerate deductions. What does that mean? If you have a big deal closing the 28th, maybe push it to January 1st. You have a whole nother year possibly to save on taxes. That bill, think about that bill due April 15th or April 15th of the following year. Same with expenses. You can prepay. Most clients are cash basis. That means if you pay it before year end and it clears your bank account, counts as an expense. These are small, but sometimes large ways to blend your money year over year. Maximize retirement, buy that auto or bonus depreciation. Typically you're not having equipment in your business besides an auto, and you have to run payroll. So if you are an S Corp, you need to make sure you're paying yourself something. The answer is never zero. And again, email your CPA. I have links. I can't control my own calendar. It was crazy. But most of the time, a client just needs a 5-minute call, a 15-minute call. Everything could be done in that time frame. Yes, I have longer calls, 30 minutes. But you send an email, we'll answer, or your CPA should be able to answer. The idea is don't do anything that we can't reverse, as in calls before. I had that client. They were a client for many years. They didn't book a 5-minute call. They did XYZ. And then after the fact, I found out about it. And I'm like, you lost $100,000 on a 5-minute call. And this client called me all the time. But for this item, they didn't. I don't know if it's on me or them. I'm pretty sure it's on them. But that is a very crash course on taxes, for real estate industry professionals. And I will open it up for questions.
You did great on timing. We have
Thank
about
you.
10 minutes left. I was going to tell you a few minutes ago, and I thought, no, I could see your slides. You're almost done. So that was perfect timing. So anybody have any questions, you can unmute or put it in the chat. I think lesson that I took away, avoid the orange jumpsuit. Great reference.
My partner used to use that line all the time in front of clients. How do you look in an orange jumpsuit? And
Yeah.
he sometimes blended it in with how do you look in stripes. But the idea being is like if you could fully justify ordinary and necessary business expense, I'm not, going to opine on it for law, but if it's necessary and ordinary, you should take it. Can you still lose against the IRS? 100%. The IRS is not a logical organization. They could shoot you down and you'll decide whether you lawyer up or not. But the idea that is if you could try to prove ordinary necessary, then you should go with it. And especially that line's blended with a lot of our influencer clients who want to write off 100% of their daily life. It's more on them who have pushback. But on clear business owners, it's not difficult to do necessary and ordinary business expenses.
May I put your email in the chat, Jay, for anybody who wants to get in touch? Great. Okay.
Correct.
And then
Put my email. You could reach out for a Schedule C tracker if that's the size of your business and you were like, what I'm currently doing is not right. We'll send an Excel. It's a great idea to make sure that you're keeping track of your expenses to send to your year-end CPA or to do your taxes yourself. It really is up to you. But keep track. If you want takeaway, make sure your books are up to date. There's no reason you're still redoing your books on January 15th of the next year. It should be done already by December 31st.
Right.
For
And
the
we will post a recording of this in the member portal. We'll send all the registrants an email with a link.
Perfect.
So once you log into the member portal through hgar.com, you'll be able to download the recording, and we'll put Jay's presentation up there too.
Jay, it's Tracy. Thank you so much. I have a question.
Yes.
Is there an app you'd recommend? Our realtors are on the go. They're using their phones, that they can put things in easily to track expenses, and then they can somehow upload it or something to the C-schedule spreadsheet. Is there anything you recommend?
There are. QuickBooks does have that, but I usually say for certain individuals, QuickBooks is overkill. I'm in QuickBooks every day. I don't know how to do bookkeeping. I have a bookkeeping team. I'm in QuickBooks every day as a CPA adjusting journal entries and high level stuff. But if you need to stay in your real estate lane. You can't be learning how to do QuickBooks, but QuickBooks, the certain packages have apps and additional items where you could take pictures and upload it. However, it might be overkill for a certain individual. There are other apps. I typically don't see them just because a client's going to give me their profit and loss. I'm not asking for the support. The way we do it is that clients should always have their support, and certain support you don't need if it's small. Like you don't need to keep that receipt for a $5 coffee. If you are deducting it, there are risks, of course, in any case. But there are apps. I mean, a lot of times we're recommending one of our clients who are moving to Florida. I use this a lot. All our billionaires and 100 millionaires have moved out of the tri-state area already. The ones left are the 10 to 100 million, and those are now leaving. They are using an app to track their location because New York and New Jersey are aggressive in trying to make sure that they get their fair share and you didn't really move. So that's an app I typically recommend based on location tracking, where it's like, here, I'm audit proof because that's a big audit.
That's very interesting.
For expenses, I'm sure there's a ton on the App Store. And it's also built into multiple. If you're already using an accounting program, most of them have either some app that they've personally built into their program or one that can be linked into it.
Yeah. Actually,
and your spreadsheet is Excel, right? That you're going to.
Yeah, my spreadsheet is. It's like I ask clients, do they know how to use Excel? And like most people are like, yeah, sure, of course. And I'm like, this is the really basic. It's like 1 + 1 = 2 type of an Excel. Anyone could use it. It's by month. I use a lot. I don't look at the month. We'll scan it, sometimes to make sure that things are in line. I'm looking at the total year-end number on the right-hand side. But the by month category is for our clients. And I hate when I see even numbers, skipping. I know they're not doing their books properly. And a lot are in the real estate world where they're like, I'm too busy to do this. And I'm like, that's not a problem. That's on you. You're too busy to save on taxes because I know they're estimating wrong. they're all conservative, or a number just doesn't make sense, and I'll push back and be like, this is a red flag.
Yeah. I actually put in the chat, we have an affiliate member at HGAR who offers an AI
Perfect.
bookkeeping service. It's called Tabby. I put the link to our affiliate page and the link to their website directly. So if anybody's interested in contacting them, they've been an affiliate for about a year. So that's another option as well.
Perfect. Key tax strategy. It's so simple. Make sure your books are right.
I
You're
have
a
a
business owner.
question.
Yes.
You had said the 1099 needs to have the business EIN, not your social security number.
If
So-
you are moving the money, if the money is being reported on a business entity.
So if it's an LLC,
If an LLC reported as a Schedule C, so an LLC, 100% owned by one individual, is called a disregarded entity. It does not exist in the tax world, really. It's a legal entity. It passes through. So an LLC, that's 100%, that doesn't go to a S Corp or a partnership. It's 100% owned by one person. Think about it. One person owns it, it can't be a partnership. So that LLC reports it on a personal return as a Schedule C. It can use either your business entity's EIN or your social.
okay.
If you elect S Corp as a business entity or a partnership or different, that requires an EIN number. But if you're an LLC personally, 100% on your personal return, no business returns, it can have both. It's interchangeable.
Okay, thank you.
No problem.
Hi, this is Winston. Thank you so much for the presentation. So you mentioned I live in Manhattan, and I do most of my business within the 5 boroughs. And I was just wondering if S corporation would be a good option for me. But from what you said, it's New York doesn't recognize it, right? So it's not. What would you suggest for people who start making over 250K annually?
So it's New York City that doesn't recognize it. So for you, if a significant portion of your, let's call it New York income is outside of the Manhattan and the 5 boroughs, you could allocate the income outside, not have New York City take it, and you could benefit from an S Corp election. Only the New York City portion would have that additional New York City tax. So it really depends on your income, but it can work because it's the New York City tax for your New York City income. The New York income can benefit from, you see, that's the next slide. New York City. New York City doesn't resonate the S Corp. New York does, and federal does. So in your world, it's allocation, and allocation is key. The brokers I have in New York City, a lot of them live outside New York City, either New Jersey or Long Island. And I ask them every year, like, did you do any deals outside of New York City? And they're like, no, it's New York City where I make my money. And then one has like, oh, I've done one deal and it was small. I'm not going to start allocating outside of New York City for a tiny bit amount of money. But it's worth to look into. And the way the S Corp works is it's got to be like, with you, it wouldn't be 250, it'd be higher just because you'd have to jump through a lot of hoops, and it's got to be the income outside of New York City.
Got it. Thank you.
No problem.
I'll be on the line.
Any other questions? How many people are we today?
At one point we had about 37.
Oh, very nice. Right around 36 numbers. Perfect.
Yeah. All right. Well, thank you, Jay, so much. We appreciate your time and all this great information, and we'll make sure to share your information so anybody can reach out individually. And thank you all to all the members who attended today, and to Tracy for coordinating everything. And here's to staying out of the orange jumpsuit.
Yes. Awesome.
All right. Have a great afternoon. Thanks, everybody.
Thank you. Have a great day.
Thanks.
Thank you.